This is Michael Coronado. I am with Pronto Advisors. We're located here in Miami. We are an accounting and tax advisory firm. We work with folks who are in real estate primarily, but we do or have multiple businesses. So we work directly with business owners to understand their financial past and not just act as historians, but work with them to build a better future as we look at ways to save money on taxes where applicable, improve cash flow, and things like that. One topic that comes up a lot for me is this about death and property and death and taxes, which is an age-old expression. But I do get a lot of questions about property taxes as well. So I am very, very excited that we have Roberto Pelaez with us from EPSAPS, which Florida Property Tax Appeals. So I'm super excited. He has a wealth of information as he's been in this industry for quite some time. As we go through the presentation, he will kind of bring up, I think he has a great section on what happens with property taxes when folks purchase homes, or I'm sorry, when they pass away, what happens, who stays with the home, with the homestead exemptions, how does that impact your property taxes? So there's lots of great information on there. And he's also specializes in doing those appeals. So if you've recently purchased a home, and he could talk more about that, they're great at actually appealing. So I'm not just a friend and a colleague, but also a client. So I could definitely attest to the ability and skills that they have in helping folks get lower their tax bill where possible. There's some situations that don't. That's one of the reasons you reach out to them, and I'm sure we'll cover those. If you wanted to say anything.
Thank you for having me. My name is Robert Pelaez. I'm the founder and president of Florida Tax Appeal Professionals, FTAPs. I've been doing property tax appeals in Miami-Dade and Broward County and throughout the state of Florida for over 20 years. Mostly commercial, multifamily, industrial properties, and also non-homesteaded properties as well. So we'll get into the discussion on what a homestead exemption is, save our homes, and things like that as the presentation goes on. So thank you everybody for joining us, and Michael, take it away.
Awesome. So I'm going to start with this about taxes, and especially what happens when you die, when you pass away. Folks think about how much and you inherit. Folks think, how much tax do I have to pay when I inherit? And I'm going to sort of spoiler alert: you pay nothing, and in all cases, because that is the state's responsibility. But if you have a lower value in terms of your estate, the estate itself may not and you have a business, you have real estate investments, you have stocks, bonds, you have your home that you own. You have these multiple different things that you want to have. So insurance is one of the protection mechanisms, but it could also be an investment vehicle, right? You have retirement accounts, you have other assets. And really, when you have this and you're in the $1 to $5 million in terms of net worth, you're looking at this and saying, well, it's not just what you own, but really what happens when I pass on? Well, the good news is under $15 million, the federal estate tax, there's an exclusion. If you're a single person, right? $15 million. If you're married, it's $30 million. So it doubles. So that's incredible. This is where it is today. And I want to highlight that, because through the years, this number has increased. It went away for I think there was 2 years back in the early 2000s where there was no estate tax, and so the joke was those were good years to die. But that did that thankfully didn't cause anyone to meet their their maker at that point. But yeah, there's this exception, and below that $15 million, you really don't have a lot to worry about in terms of estate tax. Again, the state pays the tax, not you, which is what I gave you that kind of spoiler alert, right? Do I owe taxes when I inherit? Absolutely not. It is the estate. But when people, approach me about tax planning, they ask me a lot of questions about, well, how can I pay no tax? I've heard, I've seen these TikTokers and these Instagram videos about I pay no tax. I just create an estate and I pay no tax, and that's not true, right? That's not true. It's been debunked. The IRS is looking out for these things, but where it does help you is when you do estate tax planning, which is when you again meet this over $15 million per person or 30 million if you're married. Uh, uh, yeah, right. So you're looking at this and saying, well, yeah, and again, this is at a federal level. We're blessed here in Florida. We don't have, right? And so the same thing holds true for estates, but for other states, right? There could be some states where you're impacted to as low as $1 million. So in those cases, working with an estate attorney, you would look at potentially setting up trust so that you don't have to uh, worry about the estate being diluted by this major tax bill that's going to maybe impact your descendants and the folks who inherit from you. So when you pass on, your assets don't move on with you, right? So they don't die with you. What happens? 100% of them need some sort of plan for succession. Who are these assets going to be? Who's going to be receiving these assets? And there's lots of questions that we'll have about it, right? So when you die, your property doesn't just disappear, right? It doesn't go along with you. The undertaker doesn't take it with you. But now you have to figure out a plan for these things, and having it sure some sort of estate planning that includes a will is the way to go about making sure that those things get distributed as you would like. But you have to think about those things. Who receives it? How is it valued? What taxes apply, right? So we talked about the estate taxes, but some of the other taxes that, if it's a business, ongoing business, it has uh, income tax that it may have to do, or it may have to worry about sales tax liability or payroll tax liability. There's all these things that need to be kind of uh, considered as you're coming up with a plan, uh, and considered as well as what's the ease. Here I have specifically about a property, but how easily can a business? Well, business, not every business gets sold. In fact, that's actually one of the issues today is a lot of businesses go on the market and end up never being sold. So there's some difficulty in that. So you have to think through some of that succession planning as well. And if you are in a case where there still will be some tax liability, can the family afford the tax bill or the estate afford it? Will you be hindering them? And so that's one of the questions and things that people look at when they say, should I do uh, estate planning or should I have a life insurance policy? And those things, life insurance is outside of the estate, right? And so that's another way that you could help offset some of those uh, uh, in some of those cases. All right. So now imagine for a second you have a $2 million real estate problem. Well, because why? Because you have a real estate portfolio. You might have some Airbnbs. You might have some multifamily rental properties. And now you're looking at these and thinking, well, great. Now, I pass on, and what happens? Well, depending on the loan, right? There could be legal financing issues because the bank could come out and say, well, in my case, Michael had personally guaranteed the property. And so since he's passed on, we are going to accelerate the requirement to pay for this property mortgage and pay off the mortgage. And so planning for those things that are maybe very detailed, right? I'm going off into the weeds and all of these things. But this is really important because you need to think through these things for your family. So because they're going to be going through your loss of you, which, there's the economic, there's the emotional, there's all of the different things that are kind of happening as during the process. So kind of thinking through these things, which can be, I know when I've had these conversations with my wife, say morbid, but they're necessary. They're necessary morbid conversations that you need to have of, how do these things happen, and what happens, and how do we make it as less as unburdensome for folks. In my case, my I have a 4-year-old daughter, so I think about, how do I make it unburdensome for her? Well, she won't have any idea what's going on if something were to happen to me. But if something happens to me and my wife, how do we make sure that she's protected and taken care of, and that she's not in a place where these things haven't been thought through or haven't been talked about with folks. So it's really a lot to really consider. And so one of the other things that's really important is date of death. And I know it's in bold and big letters. And why is it important? Well, because the date of death is going to help set the basis for property. So now let's assume property, a property has been distributed after someone's passed away. You receive the property, and now you want to sell it, whether it's a business or real estate or anything else. You're going to potentially have a gain. Well, if let's say let's say in the case of your parents passed away and they had purchased a property when the city was still, inexpensive, and they paid $150,000 for it, let's say, and you can now sell that for $1 million. You now have an $850,000 potential gain. Well, not really. One of the things that the date of death allows you to do is to do a step up in basis based on that date. So instead of it being the value that they originally paid, which would have been the case if they had sold the property while they were still alive, it's a case where you as an individual will have the opportunity to now be at the stepped up basis. Could be, that $150,000 property maybe today is worth $1 million. And you decide to hold on to it for a few years and sell it for $1.2 million. You have this million plus profit from what they originally paid for the property. It's now actually going to be much less. It's going to be reduced because the basis is now when the date you inherited it. So why do I say this? Because a lot of folks, obviously not the date of, but around the date of someone passing, you want to have some documentation, whether it's an appraisal or additional broker opinion or some sort of valuation for the business. If it's a business, right, having a valuation done so that you know what the value of the business is of that date, so that if and when you decide to sell or move on, you have not strictly related to the death. For some reason inherit a property and want to sell it, and you're going to have a big gain. Folks who are familiar with the 1040 personal tax return, but there's also something known as a 1031, and a 1031 is an exchange that allows you to delay the tax burden. So it allows you to sell a piece of real estate, and instead of recognizing that profit at that moment, you're able to reinvest it in a property that is of much higher value. And this helps your family not be, or you maybe particularly enjoy some of that property prior to your death, and your family to still benefit from the increase in basis. So this all creates a family problem. And what is it? One property can really create 3 problems. And I like this. I think it's really indicative of all the thought that needs to happen in these cases, right? You have ownership. Who gets it, right? You want to make sure that that's clear, and that they're able to avoid probate, and they're able to work through and not have any consequences of that. What tax consequences arise? Again, if we've talked about estate tax being the responsibility of the estate, but if you have a business, what are the taxes that the business needs to pay? Does the business have sufficient liquidity? What are the sales tax and payroll tax liabilities? How do those all fall into play? And then the liquidity. Will the family have enough cash? And I alluded to that a little bit earlier about uh, life insurance, right? Life insurance is provide liquidity. Yes, you could you have a business and it's worth 3 million, 5 million, $10 million. You have real estate portfolio that's worth 10, $12 million. Great. But what about the liquidity, the cash, right? Because you can be asset rich and cash poor. And so this is the opportunity to go and address those things as you're planning and potentially have a life insurance policy that would help them in those cases. So, if you have $0 in liquid cash, it's not a good place for the family to be, because they'll have immediate expenses of burials and things, and even maybe potentially some legal with the prior planning. So you have liquid cash, you have $0. Again, life insurance. How do you deal with that? What's the debt? What's the ownership structure? And so they're really just this question of, you need to have a plan in place to make sure what are your loved ones going to receive? How are they going to receive it? How do you make sure that the estate pays little to no tax, that you do the right planning, and that there is clarity for everyone involved, and where you don't have liquidity, having options of life insurance and such, so that it's easier for folks to go move on once you're gone. And the same thing with a business. How do we go about, how do you make sure that there is continuity planning in a business? There's a lot of folks here who are business owners. How do you make sure that your business will be able to move on without you, and be in a position to be either continue to be operated by your loved ones or to be sold? With that, I will hand the mic over to Robert, who will talk a little more about what happens after death when it comes to property taxes.
All right. Okay. So, well, Mike just said the answer depends heavily on where the property is located, how it is owned, the type of property, and the applicable state and local rules. So we could go through each one of these one by one in the next slide, and I'll give you a detailed explanation for each one. Let's see. I want to go through the next one. Yeah. All right. All right. So those four same questions, we're going to answer them now. Where the property is located, obviously, we're located here in the state of Florida. So the homestead exemption on that property, the rules are the same throughout the state. The only difference is from county to county is the millage rate, which the millage rate is a tax rate that property owner pays on the value that the property appraiser's office places on the property at. How the property is owned. So if it's a primary residence or commercial non-homesteaded property, if it's one owner on the property, once that property owner passes, the exemption or any exemptions that they have on the property are gone. There's nothing left. It's not left to anybody. It's not left to an estate. So that one owner benefits from those exemptions for the number of years that they were living in the home. But once they pass and the family or whoever inherits the properties, they are no longer entitled to that exemption. If the property is owned either by a married couple, co-owners, it's very important for everybody to understand that both owners must apply for the homestead exemption when they want to establish that home as their primary residence in the state of Florida. So you could have multiple owners of a property who are either married or co-owners living in the home together for 20 or 30 years. But if only one of the owners applies for the exemption at the time that they purchased the home and that individual passes away, the remaining owner spouse does not benefit from that exemption if that individual never applied for the original application. And I've seen that numerous times over the years where people would call my office saying that they were living in the home with their spouse for the last 25 years. The spouse passed. The year after they passed, they received an astronomical tax bill. And the reason why is at the time that they applied for the exemption, unfortunately, the spouse only applied for themselves, thinking that the spouse or the other co-owner would benefit from that exemption, but that's not true. So both, whoever wants to apply for the homestead exemption, they must both apply at the same time when they're claiming their residence as their primary residence. Then, if the property is held in a trust, multiple trustees, if one of them passes, the other continues. So the exemption stays with the remaining survivor. Once everybody is gone, whether it's 2, 3, however many individuals it is, the exemption the next year is gone, and the property gets fully valued to market value the following year. If it's held in an LLC never receives a homestead exemption. It doesn't matter if you're the operator, owner of that LLC, and the home you're living in is under an LLC, you will never receive a homestead exemption if the property is held under an LLC. The type of property, obviously, homestead exemptions are only for primary residences, no commercial properties, rentals, or second homes will qualify. And then some important dates to remember. January 1st of every year is when you physically need to be living and establish your residency in the home that you want to claim as your primary residence for that tax year. So let's just say January 1st of 2026, if you want to apply for homestead exemption for this tax year, you must have already been residing in the residence prior to that date, meaning that you need to have changed the driver's license to the address that you want to claim residency. If you have car registration, voter registration, all the utilities have to have the address of the property you want to claim homestead exemption on as of January 1st of the year that you want to claim the exemption. March 1st is the deadline every year to file for the homestead exemption. So you file it before then. Property appraiser's office, they review the application. They either send you an approval, and then once you get approved, there's really nothing else for you to do moving forward except just continuing to reside in the property. Or if they send you a denial, which is what's happening now in about a week or so, Miami-Dade County is going to be sending out what's known as a trim notice, which is your proposed tax bill for this year's property taxes. You should see the exemption on there if you apply for the homestead exemption. If you deny it because you got denied for some reason, you do have an option of filing an appeal to appeal the denial before the value adjustment board, and you just have to give them the reason why you believe you qualify for the exemption. So that appeal period is actually going to open up now when those proposed tax notices get mailed out to all property owners next week. Okay, then we'll move on to the next slide here. So then we get into what is a homestead exemption, what is Save Our Homes, what is portability, and then what happens to those when there's an ownership change, whether it's through an inheritance, and then the property being reassessed after the ownership changes due to the passing of the owner of that property. So homestead exemption. It takes up to $50,000 off the taxable value of your primary residence. So you must be living in the home as of January 1st of that date. You apply. If you get approved, what happens is that they take off $50,000 from the taxable value that the property appraiser's office determines your value to be worth as of the year that you apply for the exemption. Let's say, for example, you apply for 2026, they grant you the exemption, they send you your proposed tax notice in August. You're going to see that your market value and your assessed value are going to be both at the same value, meaning this is your base year moving forward that you established for your homestead exemption. So that $50,000 value gets deducted off of your market value, which then creates your assessed value, which is what your property tax is based off of for your primary residence. So instead of paying property taxes on $500,000 market value, you're actually going to be paying property taxes on $450,000 value. And again, the tax rate more or less is around 2%. So your tax bill would always be about 2% of whatever your assessed value is for that year. Save Our Homes. This is where the benefit of having a homestead exemption long term for many residents in the state of Florida, because you build this over time. So once you establish your homestead exemption, your base value is essentially the value of the home as of that year. Meaning if you established your base value back in 1998 or 2000, you're talking about a value that was probably, well, not probably, but significantly less than what it's worth now. So you build that Save Our Homes cap from the moment you claim the homestead exemption through however many years you stay residing in that home. And then that benefit then brings you to point three, which is portability. So basically what portability is, it's the difference between the market and the assessed values that you accumulate over the years that you claim that property as your homestead exemption. So let's say you apply for the homestead exemption back in 2000, your base value for property taxes was $200,000. Moving forward, that assessed value cannot go up by more than 3% annually. So that means that $200,000 assessed value is capped to a maximum of 3% annually, and that's what your property taxes will be based off of every year, regardless of what the market value does. Obviously, that $200,000 home today, let's just say it's worth $1 million. That $1 million valuation plus whatever the assessed value is from the time that you applied for the homestead exemption to the current time, the difference between those two values is the portable value that you could transfer over to a new home. The maximum amount that you could transfer over is a $500,000 portable benefit. So if you decide to upgrade your home, go from a $500,000 home to a $2 million home, you can only transfer up to $500,000 in portable value to that new residence. If you downsize from a $1 million home to a $400,000 home, and you have $500,000 of portable value, obviously they will not let you transfer the whole amount and not pay any property taxes. It's actually based off of a percentage of the difference between the larger home versus the downsized home. So you don't transfer the whole $500,000 portable value to the lower home, but you still get a significant benefit by porting over that amount, whether it's upgrading your home, whether it's to downsizing, if that's what you decide to do. Okay. And then what happens when the property changes hands? Okay, so for this slide right here, basically the tax figures that we're using an estimated 2% average millage rate, which the millage rate is a tax rate, is applied to the assessed value. As I stated earlier, a co-applicant on the homestead exemption must be on the deed, and it does not need to be a spouse. And the homestead exemption can be held only on one property. You cannot have a homestead exemption on multiple properties. So let's say, for example, Maria bought her Miami home back in 1998. Perfect example. Prices back then, significantly lower than where they're at now. Let's say the market value as of today for 2026 for that home is $700,000. Because Maria established that homestead exemption back in 1998, when the property values were significantly lower, she was capped at a maximum 3% increase on that base assessed value from 1998 to today. So over that almost 30-year period, let's say the assessed value only increased up to $220,000. So that's what her property taxes are based off of because of that benefit that she developed over those almost 30 years. So she's paying taxes on an assessed value of $220,000 versus paying property taxes on value of $700,000. So her tax bill would be the $220,000 assessed value less the $50,000 homestead exemption. So her assessed value would be $170,000 times the 2% tax rate. So her tax bill will be $3,400 for the 2026 tax year. Okay, now a couple of examples of what happens when Maria passes. Maria passes away. The first example, her son, Carlos, inherits the property. He inherits the property in 2026, and then he decides to rent it out. It's very important. I know Michael brought something up earlier when it comes to the dates of when things happen. So anything that happens after January 1st. So if Maria passed away on January 2nd, that entire tax year, let's just say 2026, that entire tax year, whoever inherits that property would benefit from Maria's homestead exemption for that entire year. So they would still pay taxes, property taxes in 2026 on an assessed value of $220,000 less the $50,000 homestead exemption. The property value gets reassessed the year after of the property change in ownership. So in 2027, Carlos inherits the property in 2026. Then in 2026, he rents it out. Come 2027, the exemption, he loses the exemption for 2027. The Save Our Homes at 3% limitation on the assessment increase is lost. they reassess the property to market value. Let's just say that the market value remained at 700,000. He has to pay taxes on that full market value of $700,000 with no exemption and no safer homes. So the tax bill goes from $3,400 all the way up to $14,000 because of the loss of that exemption. Let's say Carlos inherits it and then he decides to move in and claims that as his primary residence. He inherits it in 2026. He moves into the home before January 1st of 2027. He applies for homestead exemption. He applies for Save Our Homes. He gets approved. Come 2027, the exemption is going to be a new exemption, and the Save Our Homes is going to start from the very beginning. So his base value for 2027 moving forward starts at the $700,000 market value. So moving forward from there, that $700,000 market value cannot increase by more than 3% annually, the assessed value. Obviously, the market value could go up to $2 or $3 million, but that's not what he would be worried about. He would be worried about the assessed value staying capped at a 3% maximum increase annually, since that is his homestead exemption. So the exemption, it's a new one. Save Our Homes starts over from the beginning. The base value is $700,000. He's taxed on $650,000 that first year because, again, you have to deduct the $50,000 homestead exemption. So his tax bill will be $13,000. A little bit better than the $14,000, but obviously, still a big hit from when he inherits his property. And then the final example would be Maria lived in the home with a co-applicant. Again, whether it was a spouse, a relative, or a friend, they co-own the home. They both applied for homestead exemption. Okay, Maria passes. The co-applicant, the exemption continues with that co-applicant. The Save Our Homes 3% limitation on the assessed value increase stays with the remaining applicant. There's no reassessment, so the tax bill for 2026 obviously will stay at the $3,400, and then the following year, 2027, the assessed value will still stay capped at the maximum 3%, since that co-applicant is still surviving, still living in the home, and they're still entitled to the homestead exemption. So those are basically just a couple of examples of what happens after a property changes ownership. One thing which I don't think we have in the slides, for non-homesteaded properties, let's say for a commercial property or an industrial property, rental property, any property that does not have a homestead exemption, there are some assessment, there are some cap limitations on the assessed value increases as well, but those are 10%. So annually, non-homesteaded properties, the assessed values can only go up 10% maximum per year. So if a property's market value in 2026 is $1 million, if it's a non-homesteaded property, the market value could increase the following year to $2 million. But that $1 million assessed value can only go up 10% the following year. So we're talking about a market value of $2 million and then an assessed value of $1,100,000. The important thing to know for non-homesteaded properties is that there is taxes to be paid on the difference between the market and the assessed value for non-homesteaded properties, which will be the school board portion of the tax rate, which is about 0.6%. So you still pay taxes on a non-homesteaded property on the difference between the market and the assessed values, but it's only on a third of the tax rate. And then the assessed value of that non-homesteaded property, which is a lower value than the market value, on that assessed value, you do pay taxes on the full 2% tax rate. So there is some savings there for non-homesteaded properties. Obviously, it's not as advantageous as homesteaded property, but there is still some tax savings there as the property increases in value over the years, that when somebody inherits a property or it changes ownership, they need to be made aware of the fact that their tax bill is going to go up. It won't go up as significantly as a homesteaded property, obviously, but there will still be a tax increase on non-homesteaded properties as well that individuals need to be made aware.
That's amazing. Thank you. That was, I think, as I stated before you came on, definitely very well versed in all of everything that has to do with this, and definitely really appreciate it. Even though we've had multiple conversations on these topics, I learned some things. And what's interesting to me is I talked about the basis of a home, of real estate working in your advantage is a stepped up basis. It increases, but here in this case, right, where you take over the property, it doesn't help you because the property taxes go up substantially from almost $10,000, which goes back to my original thing about Are you sure your family is going to be a good place from a liquidity point of view in order to take care of some of these things? But thank you.
Oh, you know, and I just wanted, yeah, I just wanted to make one more thing that I forgot to mention. We've had questions over the years. Individuals have asked me if they add somebody to the homestead after establishing the homestead exemption for 20 or 30 years. If you do add somebody to the title of the home and then that individual wants to be added to the homestead exemption that's already been established for a number of years, the homestead exemption gets reassessed. The property gets reassessed. So there's really no way of extending that homestead exemption beyond the 2 individuals or 3 individuals that initially applied for it. So if you add somebody 5, 10, 15 years after the initial application was signed, the property gets reassessed to the current market value. Just something that I've had that question asked for me numerous times over the years. So it's important for people to know that if you add somebody to an exemption that's been in place for a while, the property will get reassessed the following year.
Oh, that is great. That is great to know. I know, and kind of to your point about portability earlier, for the IRS, there is some opportunity for portability and exceptions, and that's questions that kind of moving back to federal income taxes. That happens. It's the spouse question, right? People can be into estate planning opportunities because you are able to potentially use a deceased person's unused exclusion in your portability election if is properly made. So you're able to take advantage, different than just property taxes, but for the IRS issue, you can actually transfer and take advantage of the deceased person's unused exclusion amounts for the tax year. And again, dates become really, really important. So now, if you're listening and you've been along with us all this time, and you think, gee, Michael, but I have a will. Well, a will is only a small portion of it, and we'll talk about it. So I have a will. Well, it's not the whole one, right? There's a reasons to have a trust. There's a reason to have beneficiary designations. There's reasons to see how business ownership survives. There's reasons to look at real estate ownership and insurance and tax planning and liquidity. So you have to look at this entire plan, and I think we've touched on different portions of it throughout. And tax planning includes the property tax planning, right? Your child inherits a property and they have an additional $10,000 tax bill. How are they going to account for that? Do they have sufficient liquidity? Well, and as I put here, it's not about who gets your assets, it's about how those assets get there. And that's really how they get there and how much of it gets there, right? Making sure that as much of it gets there. So saying, hey, I have, it's a big mistake. I have a will still involves probate, still involves other complications, and it's not part of the overall plan. There are cases, of course, where it's, simpler cases where maybe it doesn't make sense for you to actually go through doing a trust and other things. But you probably have a bank account. You probably want to have benefit. You don't want little Jimmy on your bank account, but maybe you want to add little Jimmy as your beneficiary, or for bank accounts, for business, for other things, and allowing them to potentially avoid or have limited exposure to probate. And with a conversation that I had with my wife as we were going through these things, when we're looking at our daughter, it's like, I don't want the courts to decide. I want to be able to decide ahead of time. And that's kind of what this is all about. You're doing something active in order to get ahead of it. And so another common thing or objection, or I won't call it a mistake, but people say, I'm too young to worry because I'm in my 30s. And why do I need to worry about it? I don't really have that much money, or I have some real estate, but yeah, well, now with real estate in lots of areas, $1 million is uh, fairly common. In I know in Florida, that's much more common than it was even 3-5 years ago, $1 million home. So if you think you're too young, the only requirement to pass away is to be alive, and that's always the thing. So you should really look at these things as you start hitting these milestones. Well, I have money. I have some money in the bank. I have a 401k. I have retirement accounts. What do I need to do? How should I be planning for these things? Making sure they're up to date, right? People, things happen. they had, their parents, and now they're in a relationship, or they had a former relationship. I've seen that happen actually quite often, where someone passes away and their second wife is going to go claim the uh, 401k, and they come back and say, well, his first wife is still a designated beneficiary. We're so sorry, it goes to her. Oh, he meant to update it. Well, if he didn't do it, right? And so doing these things and being cognizant of them, even at a young age, and getting started on the conversation. It's really, you really start there and you just go building on it. Um, and at what point does the strategy change? Here, you get to over 15 million. That's really where the strategy starts changing. You start looking at trusts in a different light. And as your estate planning, it shouldn't be something you wait till you get here, right? You can start here. And like I said, with real estate being at close to $1 million in a lot of areas, it's pretty easy to get here. And so you wanna just start the planning there. And as things kind of go migrating on, you have the right things in place, and the right structures and the right planning, and that goes as well for your business. So I think the real thing I want to leave you with are kind of three things: build it, you're building your wealth, you're protecting it, and then you transfer it on. And that could also mean to charity, by the way. It doesn't have to just be to your loved ones, right? So build it, protect it, transfer it. You're building your income, you're building your business, you're building real estate empire. Whether it's just, oh, I just have a couple of Airbnbs. People tend to downplay what they do or what they've built. I was recently speaking to a physician who told me how he had real estate investment, and that he had previously lived in Arizona, and he had invested in a bunch of land down there, and he builds some spec homes and sells them. And I said, well, sir, this was towards the end of last year. How many homes will you have sold this year? He says, well, I think by the end of the year, we would have sold 40 homes. Sir, you are a developer, right? I understand you're a physician and you're doing all these things, but you don't downplay it. I mean, yes, downplay it out publicly if you want, but for the importance that you need to give it, your real estate empire, whether or your business or your income, or even just your stock portfolio. Let's you built it. Now let's protect it. Let's have the right entities in place. If you need a trust, speak to an attorney and get that set up. If you need the right insurance, there's also some tax advantaged insurance vehicles once you get into higher net worth individuals that allow you to potentially have that money grow tax free. It's just a part of an overall tax strategy. And then transfer, you to your estate, to your trust, to your beneficiaries. What's your succession plan? We talked about the business. What's your succession plan for the business, and making sure that that the business can live on once you are gone. So I think, like I said, build it, protect it, transfer it. I know we're right questions to ask. There's a bunch. Who owns the property? Who receives it? Start thinking about these things. You'll see it on the recording when we send it out. But I do want to leave some time for live Q&A. I don't know if there's been any questions come up on the chat, but feel free to unmute yourself and ask away for myself or Robert to answer. Awesome. Well, if you have questions, I'm going to put up my info here. If you want to scan this QR code, you also get an email with the link for booking link. You could have a free tax savings blueprint. Yep, and it's on the chat as well. Thank you, Mira. So it's on the link there as well. We'll send an email with the follow-up, and it will have that as well. And if you want to engage with FTAP's Florida Tax Appeal professionals, please scan that QR code or visit them at ftaps.com, and you'll be able to assist you with appealing your property tax assessment. And like you mentioned, the trim notices are coming out right in the next week or so. So folks should be seeing that in their inbox, in their mailboxes, and be able to look at it and say, oh no, what do I do? And that's where Robert and his team can help you lower your tax consequences. And if it's nothing you could do this year, hopefully provide you guidance on things to do in the future, so that you're not in a similar situation. Oops, I forgot to do Homestead. Is there like is there an appeals process if you forgot, or is there like a oops, I
No,
forgot?
no, it's got to be where you applied for the exemption prior to the March 1st deadline, and for some reason you just got denied by the property appraiser's office. You do have the opportunity to appeal it before the Value Adjustment Board, and then they can make a determination whether you had good enough cause to have the exemption approved.
Okay.
Yeah.
Awesome. Well, again, thank you, everyone. You can't control when you die. You can control how prepared your estate is, and that's what we're just kind of shine some light on. And thanks, Robert, for your uh, support and great information. And I wish everyone a great rest of your Thursday. Take care. Thank you.
Thank you, everyone. Thank you, Michael.